FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 8/13/19. Well, hey, you've been listening to this person for the past 3 years that he's been on the show, and you followed his advice about precious metals. Well, at the very least, you wouldn't have lost anything, but probably you could have earned some really amazing returns during that time. Hey, by the way, if you haven't done it already, email me with any questions or comments or your feelings about where precious metals are going. We're going to be doing another contest very soon, very shortly, probably dealing with the price of gold or silver by such and such a date. The email address is kl@kerrylutz.com. Well, Eric Hadik is with us now, InsideTrack.com. That's INSIIDE track.com. And Eric, it's great to have you back on. So, hey, we're looking at the gold price. It's up a few $100s over the past few months, and no surprises there, is there?
No. Gold and gold stocks, the XAU index, silver, they've all had a cyclic up phase that kicked in late last year. I know I've mentioned this before, and I've sent out some complimentary reports to a lot of your listeners after offering it before. But some of the reports and articles that we published back in September through November of last year explained why I thought that precious metals were on the cusp of a 2-year uptrend, and that it would be in several phases. The first phase was forecast to go from a September low in gold shares and an August low in the price of gold into an initial high in late February, early March, and then it pull back for a couple months and then surge to new highs leading into July or August, when I thought we would see a pretty significant peak. And we're coming into that right now. And as I've explained to my readers too, I'm expecting a succession of peaks. It doesn't mean that because I think we're going to have a high and see some selling and some consolidation, doesn't mean that 2-year uptrend is complete or even near complete. It just means it's having one of its consolidating phases where you start to trade at a higher plateau, build a base, let the bulls kind of build up some new momentum, and then get prepared for another surge a few months down the road.
Yeah, and obviously it's consolidating. It's so funny, when you look at what happened to the price today. This is a real textbook case of increased volatility in the metals, isn't it? I mean, we woke up, it was up $10 the ounce, almost 11. Then an hour or two later, it's down $20. Now it's only down $9 and change the ounce. It's kind of to be expected, right?
Absolutely, and they are some classic signs of a blow-off move. Another reason why you could see a peak very soon and then see gold go into a range maybe between the spike high around 1540 or so, and on the low end could even go back to 1420, 1400, and start to build a trading range there. But as you said, that type of volatility you certainly begin to expect after big moves like this. And not only does this come into the second key time frame of 2019, when I thought we'd see the second higher high, but coming into the year, I had a couple of major 1 to 2 year upside targets. And again, they're things that I think will be met. They'll usher in some consolidation, and then the market will move on up to the next objective. And the first two of those were 1410 to 1445 and we hit that with the rally into a couple months ago. And then the second level was 15.25 to 15.50, and we've just surged up to that now, coinciding with these August cycles. So it's more reason, more corroboration to the overall outlook for another peak in this area, and the time for a bit of a trading range, probably a couple months if that 15.50 level holds.
Right. So another month. And then, hey, what's amazing, Eric, is that we're not even in the, what was I going to say, the seasonal strong period for precious metals, which is generally Q4, mid Q4 to mid Q1. So what are you thinking is going to happen during that time frame? We're going to just be disappointed because we're expecting this seasonal surge and it's not going to happen? Or does it look like it'll just resume?
I think there still is a strong argument that you're going to see another up leg during that time, depending on how quickly a top is formed here. I've been talking about seeing a subsequent low, just a pullback low, as soon as late August, early September. There are some other factors that I still need to wait and see, could push that a little farther into September. But assuming that key support levels hold during that pullback, that would set the stage for another leg up in Q4. And that even goes along with some longer term analysis and some expectations I have where the dollar's concerned and where some other factors that could help support gold and precious metals in general could kick in at that time. Interesting.
So what about silver? Silver has been moving, but it hasn't been moving that much relative to gold. At what point does silver take over the lead?
I frequently get that question and really have the same answer every time. And you have to look at the environment. You have to look at what is driving gold. And the majority of gold's up moves of the last 9 months have been on different types of either geopolitical or financial stresses and anxiety. And, most recently this surge came, it began when stocks had a sharp sell-off. And that's very typical. And so gold gets more of that flight to quality type of spike, whereas silver has to battle, if the stock market's suddenly looking a little bit precarious, silver gets pulled upwards along with gold and the safe haven status, but then at the same time, there's negative pressure on it from an economic standpoint. And is the stock market warning of something in the economy that's on the horizon? And so it's very standard to expect if we're not in a real price inflation type of environment, silver's not going to do as well as gold. That gold has other factors driving it that are not nearly as impactful on silver. And so the time when that would switch would be if and when you get more of an inflationary environment. And that being, I could see two drivers there. One would be a sell-off in the dollar. The other would be just some demand or supply-driven moves up in a number of commodities, starting to create some price inflation fears, even if they're limited or narrow in scope, but enough to get something like silver really going. And that's the time when you'll see one of these big moves up that, maybe gold's only moving $20, $30, $40, and all of a sudden silver's jumping a few dollars at a pop.
Mm-hmm. Interesting. Well, it's definitely come back to life because everyone had forgotten about silver for the past several months. So conversely, the dollar and the stock market, because the conceived wisdom, the popular wisdom, if you will, is that gold can only go up when the dollar is heading downward and when the stock market heads down. What we've seen recently kind of shows that ain't necessarily so.
Yeah, I think that mindset has been dead wrong for years, and I find myself continually explaining it, giving some analogies, giving examples. Yes, from a strictly logical standpoint, you'd say, okay, if gold is priced in dollars, then when one goes up, the other has to go down. And that's not really the case. Number one, often what's viewed as the dollar's value is something like the dollar index, a basket of many currencies. And so it's not a direct correlation to something like gold. But gold often reveals weakness in the dollar before the dollar index does. And that may sound counterintuitive, but I think that's an important point to recognize, is that the dollar's value when based in gold is often much different than the dollar's value based on a lot of other fiat currencies. And it's kind of that mindset of, if the fiat currencies, if you're really convinced that fiat currencies are all heading for reckoning, then it's kind of like rearranging the chairs on the deck of the Titanic, or which ones run into the back of the boat that's ready to go over a waterfall. Even if one of those fiat currencies looks stronger than the other, if they're showing weakness versus hard currency, and also now versus digital currency, that's giving you a bigger insight as to what's happening than just looking at the dollar value based on the dollar index or some other similar gauge.
Mm-hmm. All right. So interesting times ahead for sure. Looking at energy, because look, everything goes on energy. What are you seeing there?
FSN Radio. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Orin's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Orin's been called one of the best in the junior exploration sector. Orin trades on the TSX and the NYSE under AUG. To learn more, go to orinresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
I still expect that the energy markets entered another corrective phase in the second quarter, and that will probably extend into September. September's the time when I see the best chance for a secondary low in crude oil and the energy markets, with the primary low being late December of last year. And so I think that we're in some sort of, whether you want to call it a 2 or a B wave. Basically, it's the first correction after a significant up move, which we saw from late December into April, May of this year. But depending on a couple of factors that I'm monitoring, if crude sets this bottom the way I think it could, then post-September, we could see another good rally in the energy complex in the fourth quarter and leading into next year.
Okay. So we got interesting things ahead there. So your forecast for the dollar, you kind of alluded to it. What are you seeing with the dollar? Is it staying put, going up a bit? And then you kind of have to tie your forecast to the dollar into the euro as well, right?
Yeah, and the dollar index keeps holding below resistance. It has had critical resistance around 98.50 on the dollar index for probably 6 to 12 months now, and it keeps holding below that, but it doesn't really get any downward momentum going. And part of that is because the other currencies that are in that basket that it's based against are not gaining either. So the dollar looks stronger. It's the healthiest horse in the glue factory type of analogy.
Sure.
But that doesn't necessarily mean it's strong. And one of the things that I think is interesting, and I talked about this back in 2015, 2016, when my work was telling me to look for a multi-year high in the dollar in late 2016, early 2017. And it was that correlation between Republican and Democratic administrations and which ones favor a weaker dollar, that being the Republicans historically, at least the last 30 to 40 years, and which ones end up coinciding with a stronger dollar, which is the Democratic administrations. And at the time, I was explaining why, and this was even before the candidate for the Republican Party was known, but why that analysis in the dollar was telling me to look for Republicans to take the White House in 2016, 2017. And since then, you saw an initial sell-off for the first year of the Trump administration. And then since the trade war really kicked in, the dollar has recovered. And again, some of that is a comparative thing. One of the things that really took a hit was the yuan, Chinese currency. And most recently, they've apparently let it drop to multi-year lows again. And my thinking is that the dollar has been in a kind of a B-wave rebound. It saw its initial decline. It's going to see another decline out on the horizon, but in between those two, you get this rebound and consolidation. And that rebound really hasn't, from a wave and technical structure, hasn't looked that powerful or that convincing, but it has certainly maintained resilience in the dollar. And now all of a sudden you're starting to get the murmurings that maybe Trump would, in a worst case scenario, start to use the dollar as part of the ammunition in the trade war and let the dollar start to weaken and see how that impacts China's negotiating standpoint. So it's just interesting to me that as the technicals are arguing for another downdraft in the dollar in the second half of 2019 and possibly stretching into early 2020, that now you're at least getting some subtle affirmation of that in the fundamental arena. So obviously it would take more than just some murmurings, but if you start to see things escalate any farther, I'd start watching the dollar more closely to see if there's more convincing signs of a reversal lower. And if so, that would trigger a number of negative indicators that are very close to turning, but have not yet signaled a downturn in the dollar.
Mm-hmm. Okay, so we need to be watching the dollar. Interest rates have been cratering. We're under 2% for the 10-year. Last I looked, it was around 1.66, I think, or 7. But whatever, it's still historically extremely low. We're getting almost a 2% on the 30-year, although there aren't many 30-year Treasury bonds out there left remaining. What is this telling us?
Well, and sometimes that even leads some of the dollar movement. And, the lower the interest rates, the less incentive for holding dollars. Mm-hmm. But it's far more complex than that, obviously. And I think that you've got more of that idea that there's the fear of some economic struggles on the horizon, which could ultimately impact perception of the dollar too, that the two could work hand in hand, but there's always a lag or a lead time between those types of correlation.
Mm-hmm. Yeah. So, yes, you don't know when it's going to happen, but at some point it's going to happen. But obviously, low rates. But that's a boost for the stock market, though, isn't it? Because your alternatives to put money in, unless there's a full-scale panic in the stock market, you're basically going to say, well, I can't really get any return elsewhere, so maybe I want some money in safe haven assets like precious metals, but maybe I just keep it running in the stock market.
On the surface, yes, that's definitely a correlation, but intermarket correlations are, I think, one of the most dangerous things that, even when you were just talking about the dollar and gold. And there's this very elementary mindset out there that, they have to have an inverse relationship. And yet there's so much more that factors into that gets ignored or gets masked by the simplicity of that argument. And I think the same is true of that lower interest rates, higher stock market. If that's the driver, and this is the thing that I warn my readers, that when you're going to rely on an intermarket correlation, you need to be absolutely sure of what is leading and what is lagging in that correlation every day, because traders' perceptions can flip on a dime. And everything you described is what the governing mindset could be for 6 months. And then one morning they come in and another number is released that's weaker than expected. And that drives interest rates up even, or down even lower, bonds and notes up higher. And all of a sudden the stock market says, oh no, we're past that tipping point. We're now in the scenario where these lower interest rates have been warning of an economic slowdown on the horizon. And now all of a sudden there's a mass exodus from the stock market. And that drives interest rates even lower. So when you look at the charts, now you've got stocks going down and interest rates going down at the same time. And that may be because stocks were driving the interest rates, not vice versa. So those correlations flip back and forth. And again, I think the most dangerous thing a trader can do is just go into the market with a very naive mindset of, this is the correlation, so I just need to follow this correlation, whatever that may be. Because if they don't know which is the driving force in that correlation, it can have a complete 180-degree opposite impact depending on what is driving traders' mindsets at that point in time.
It just reminds me of what Mark Twain said. It's not the things you don't know that get you into trouble. It's the things that you think you know but aren't true that really cause you problems. And that's never more true than it is for investors, right?
Yes, that's a very good synopsis of what I'm trying to say.
Mm-hmm. So we got an interesting situation here. I think that that we're really going to find out a lot more, a lot quickly than we ever thought possible. Hey, just tell us websites. I know you've got a few of them. Where to go to find your work, Eric?
Yeah, the primary website now is InsideTrackTrading.com. But again, if you've published InsideTrack.com or they try to access it that way, they'll get redirected to InsideTrackTrading.com with that extra I in the middle of inside. And then we also archive a lot of articles and reports and whatnot on 40-year cycle. That's 40yearcycle.com. So they're the two primary websites you can go to find out more information and inquire about any samples or trials and also to access a lot of archived publications.
All right. Hey, well, as always, shoot us your questions, your comments, kl@kerrylutz.com. Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Eric, always a pleasure having you on. Really enlightening. We will catch up with you in a little while and see where these markets are headed.
Thanks for having me back, Kerry.
FSN Radio. It's all about what's next. Go to FinancialSurvivalNetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.